Good morning, ladies and gentlemen, and welcome to another Boutiques on Wednesdays. This morning we have a SA Equity panel, and I'm sure that, like me, you look forward to another month of positive equity returns if we can hold it together for a few more days. I'm Pierre de Klerk from Apex Investment Consulting, standing in for your regular host, Eugene Brock. We have a guest moderator this morning, Jessica Fannin from Amity. Good morning, Jessica.
Good morning. Thanks for having me.
Thank you for being our guest moderator. And Jessica will introduce the managers on the panel, but maybe just a quick introduction to Amity. Amity is an independent, privately owned, outcomes-based discretionary investment manager. And since 2007, they've been helping advisors and their clients to invest for real-life events, pairing specialized outcomes, model portfolios, and CIS funds with proprietary tools and hands-on support for professional advisors. They operate nationwide, and they are independent, as I said, and they help advisors to deliver truly life-centered wealth management that raises the probability of the positive outcomes that their clients require. So thank you, Jessica. You are welcome to take over and introduce the panelists.
Yeah, thank you so much to Fundrock and BCR. I think what they've built here in terms of a platform is absolutely exceptional in terms of the content that gets produced every Wednesday. So yes, we are a DFM for independent financial advisors. We manage a suite of model portfolios and funds, some with hedge funds, some long only, some local and offshore. And how we manage those is with asset allocation, macroeconomic views get built in from a top-down perspective. We obviously do manager selection, and we look at this range of equity managers that's available to us as it is to the retail investor, and obviously we do portfolio construction. And so that sort of brings me to this morning's panel on local equity. And it's really important that we understand the different views so that we can best sort of blend different equity managers for the environment we're in. This year has been an absolute gift for investors in local equity. It has outdone most people's expectations, returning 31.7% year to date to the end of September. But obviously, the challenge is that a lot of that was very concentrated in resources and more specifically in basic materials, which has meant it's actually been an incredibly difficult environment for active managers, which is the panel we're speaking to today. And so the natural question is where to from here, and how best do we understand the local equity managers that we have access to, and how do we solve for the next environment we're moving into? And so to answer all of this and more, we've got from 361, Evan Walker, no stranger to this platform. From Anchor Capital, we've got Liam Hetcher. From Centuar, we have Nick DeFoss. And from Northstar, Marco Barberi. So welcome, guys, and thank you very much for being on here to answer some of the difficult questions today. There are no slides this morning. There's no figures that we can hide behind, but hopefully by the end of it, we've got a very good sense of your levels of conviction and how you're positioned and what your views are of the world. The questions will start sort of more from a global macro perspective, and then we'll move to more granular topics and sort of specific stock selection questions. So just to get us going, Evan, if I can ask you, after this incredible year in equity markets, I think in the preamble, when all the panelists were sitting behind the scenes, you were guaranteeing some very high returns going forward. But actually, if you sit and look at the asset class and the range of opportunities available to you at the moment, what do you expect going forward from something that runs so hard this year?
Yeah, Jessica, as you rightly said, and morning everyone, thank you. As you rightly said, a very concentrated market, sort of 9-10 shares giving us sort of over 80% of the returns this year. So been very concentrated. Obviously, Plats and gold being the standout. We certainly got very little view on gold. I don't think anyone's got a crystal ball on gold going forward. I think you've got to have some in your portfolio. but now quite distorted for the SA equity guys, given that it's such a big part of the component of the index at 15% now. Platts around about 10, so 25 in precious, which is a big number. And I think, anyone running that level of concentration risk in a portfolio would be, obviously that would take on a huge amount of risk in a downturn market. And we've certainly been trimming back some of our precious exposure and switching into other components of the SA market, which have lagged. Some of them have still done obviously incredibly well. And we think the prospects generally will be very constructive for equities, both South Africa and global equities going forward. I think the starting point really is that we're seeing a repeal on tariffs. We've got a huge amount of energy coming to the market in 2026. It's a big energy year for the world. Gas, oil, huge incremental uptick in energy coming through, both on the renewable side, etc. So structurally, we see a year where inflation comes down further, rates come off more. And that's the starting point, Jessica. If you've got a year where rates are going to be coming down, I think we've got rates coming down probably as much as 100 basis points in the US. Structurally, that's a good place for equities. So the starting point really for us is that we have a good starting point. We've got an SA economy, which we think is bumbling up. We've obviously seen car sales at volume levels trending between 30 and 40% a month here. We've got loan growth that's trending up in the sort of 5, 6, 7s here. We're not shooting the lights out by any means, but we're also not going backwards. But again, as I reiterate, the starting point for us really is that we've got a constructive view of the globe. We've got a lot of structural global growth drivers around AI, renewables, big tech innovation. In 25 years of doing this job, I've never seen this amount of tech and innovation hitting the landscapes globally as we're seeing now. So, I think you've got to stick with this equity story. I think you've got to stick with it for longer, but obviously within the underlying managers, you've got to be very selective as to how they're going to manage the funds now. And we would quite happily say, given our returns, that if we underperform on a gold/platinum basis going forward, that'll be fine relative to finding other shares within the SA ambit, which are offering significantly better value. And we obviously, we would harness those returns in the next 12 months.
Great. And we'll take the positive views where we can get them. Liam, moving on to you. I think 6 months ago, if we looked at local equity, it was a very different situation in terms of there was a lot of noise around the fact that actually the platinum sector was in demise, and there was a lot of concern about SA Inc. possibly being a bit of a value trap. You've recently presented your equity expectations to your clients. In a nutshell, how much of that, just share with us basically what your expectations are for the asset class, and then how that ties in with emerging markets generally at the moment, if you can.
Sure. Thanks, Jessica, and good morning, everyone. And yes, you rightfully pointed out that the year has panned out quite differently, probably to what we would have thought at the beginning of the year. So what we do as a business, and we publish it for our sins sometimes, is every quarter we sit down as across asset classes with people sort of championing different asset classes, putting forward what the 12-month return expectation is going to be for those asset classes. If you look at our views coming into the beginning of the year, we were very constructive on local equities, which the call actually has worked out quite well if you think about it. I mean, we call, but the direction of travel is certainly not what we expected. So we were not expecting a market that, as Evan pointed out, 80% of the returns come from 10 shares. I think the golds and the plats have added over 20% of index performance this year. So when we create the forecast and we model things from a bottom up, there was no ways that we were expecting that to be the case. It certainly came into the year constructive on domestic equities, largely on a follow through of the developments that happened last year. So obviously, I think that there was clearly a seminal shift in domestic politics that happened in the elections last year, and there was certainly optimism around the ability for reforms to start taking hold. I think obviously a big wake up call for the ANC, and we just thought that maybe there would be a slightly more urgency. I would say the first quarter certainly of this year, big rotation in markets. I think the starting point potentially for the domestics on the JSE from a valuation perspective and an expectation perspective were a little bit high. We were still sort of the view that this is a 3-year trade. Let the trade play out. Maybe we weren't necessarily in the camp that we wanted to bank profits just yet on that. Obviously, the first 6 months of this year, and to be honest, it's probably gone on for a bit longer than that. The domestics have been a funding trade for where there's been unbelievable developments and earnings momentum in the basic materials space. In that, I would say that there's a couple of things that happen. I mean, there's almost like the oxygen gets taken out of the room. So there's definitely been managers in South Africa that have had to sell down on maybe overweight positioning or crowded positioning on the domestics to make space for trying to maintain some level of tracking error that's acceptable in the golds and the PGMs. I think what Evan said about managers feeling not too uncomfortable about the fact that they're underperforming an index where the index is being driven by an extremely risky and volatile space. I mean, I think we probably in that camp as well. But I think where we were about 3 months ago is we started saying, okay, that's enough. The domestics have treaded water for the best part of this year. There's been a hell of a lot of noise. I mean, if you think about what South Africa was all of a sudden in the geopolitical spotlight, a lot more than previous years. It seemed like there was certainly a target or a spotlight shone on some of the decisions that our policymakers have made. But at the same time, you had maybe the reforms that were coming through that people expected was just happening a bit slower. Certainly there was people worried about sanction risk on South Africa. There's all sorts of things. And at the same time, you had this big bull market that was developing in a very cyclical space in the PGMs. And I think the gold bull market really kicked off by the looks of things a couple of years ago. So there's there was a lot of reasons why the SA domestics maybe treaded water. But 2-3 months ago, we were sort of the view enough's enough. We were looking to try and find leadership back in that part of the market, and we maybe were a bit early in selling down some of our golds, and we maintained our platinum exposure. But certainly, our view going forward is that while there's a lot of forecast risk in the JSE from here, making my life specifically very complicated and trying to forecast what the JSE is going to do 12 months out from now. But what I have said and communicated to the market is we think the leadership shifts back. We think that there's good relative value in South Africa, in the domestics. We like, and at the same time, we think that the environment for emerging markets, which really suits South Africa, is pretty constructive at the moment. So I think there's a strong argument to be made that and I think that you've seen that the trend actually more this month come where the domestics have been leading the pack. We think that that's a trend that's maybe got some legs. And we do think that there's been some pretty positive developments in South Africa, even in the commodity space, where you're going to have the budget that you're about to receive now is probably going to be a bit easier for the policymakers to get through, because there's a lot more tax receipts in the mix as well. So we think that there's enough to keep the domestic trade constructive for now. Yeah.
Great. Moving on to you, Marco. One of the impact of the rally in commodity prices has been a massive improvement in our terms of trade, which was actually quite problematic earlier in this year. Can you talk about just simply what secondary benefits might flow through to local equities from a stronger rand and that improved terms of trade?
Yeah, it's a good question. I mean, it's been amazing to watch bond yields rally 200 basis points from the bottom of Liberation Day. You've had, the rand moving from 19.5 or 19.7 to lower 17s. And, clearly the weaker dollars played a big part in that. But, all of these aspects are creating a very supportive environment for inflation, or deflation, or as I may. And the effect of that has been important. You've had real wage growth for the first time in a long time, which has benefited the lower end consumer. And at the same time, at the high end of the consumer, you've had lower interest rates and good market returns that have helped the consumer. So, From an SA trade perspective, those are all very positive elements. If you look at the next 18 months, there's other elements to be very positive about. We haven't quite seen credit growth come through. You've got some decent corporate growth, but retail growth has been fairly poor. But there's a lot of projects in the pipeline. Hopefully we've got a few more interest rate cuts. So from a macro perspective, things look to be supportive from a 12 to 18 months outlook, which should position you fairly well from a positioning or an overweight positioning in banks, retailers, some of the SA sensitive stocks. You've already seen quite a bifurcation in returns between property, bonds, and SA sensitive equities. So, it's been amazing to watch how the ALBI has done relative to some of the sensitive equities. And that's why we feel that there's still a lot of opportunity in some of these sectors, like banks. They're trading fairly cheaply. If we look at returns for a lot of these sectors, we're seeing double-digit growth on a 2-year basis for both banks. The likes of Capitec, FirstRand, you're probably going to get high double-digit kind of growth, and they're trading on multiples that are comparable to 5-year average. So I think the macro is certainly going to be supportive over the next 18 months, bar any wobbles at a global level. It's not hard to see some geopolitical kind of issue that may derail that story, but by and large, we think that the macro is supportive.
Right. And I think if you look at the difference in the performance between, that section of local equity and then the SA bonds, it draws a correlation to what's happened with foreign investor flows. So my next question is for you, Nick. We've seen, positive foreign investor flows into our local bond markets, but actually local equity has been very much unloved by foreign investors. And, one would hope with us coming off the grey listing, that list and sort of these, our currency being far more attractive, that possibly this changes and there's a further tailwind to the asset class. Is that something you are sort of expecting and building into your views, or do you think it's necessary for some of those unloved sections of the local equity market for things to continue to grow, or is it not necessarily important to your portfolio construction at this point?
So we aware of it and we look at it. So it's not a new phenomenon. Foreigners have been selling $4 or $5 billion odd of SA equities every year for almost, it feels like almost like a decade now. So consistent net sellers. But it's not just the foreigners that have been selling, it's the local guys have also been selling. I think the average balance fund is probably close on 40% offshore content. So all these things have been putting pressure on SA equities, and like the previous panelists mentioned, we've also had this added kind of vacuum on SA Inc. specific names where they've been sold at the expense of precious metals. And then I'd agree with a couple of comments that have already been made. That kind of vacuum or persistent selling, I think, has created a hell of an opportunity. Particularly in the banks that were just mentioned. We think they look very attractive. So and even if foreigners don't decide to come back into the SA equity market, you're still getting very good rolling yields on a couple of these names. So the banks, you're getting 7-8% dividend yields. You would think that they would grow at kind of like nominal GDP kind of levels. So you're still getting a teen return. Without the foreigners coming back into our market. I think part of the reason you mentioned that they've been buying our bonds and not really the SA equities is because they don't believe the growth story in SA. So we'll have to show some kind of a level of GDP growth for them to get interested. And my understanding is at the moment they're looking at regions like Latin America where they prefer kind of equities there where they're getting growth. Versus an SA. But it's not going to take a lot for them to start looking at us again. You mentioned the grey listing, the terms of trade mentioned earlier. The precious metals should create a bit of a tailwind to our GDP growth, and hopefully we can get it up over 2%. I think forecast for next year is probably 1.6, 1.7, but yeah, maybe that gets closer to 2%.
No, great. Fantastic. Evan, coming back to you, in your sort of preamble, you talked about the fact that tariffs were being rolled back, and the prospect of significantly lower inflation, I suppose, globally. And obviously that creates room for interest rates to continue to be cut. If we bring that back home to your equity portfolio, how is that being positioned? I know currently in the fund, and this is to the end of September, financials are the biggest sector allocation within your fund. Is that being maintained or trimmed, or how's that sort of being incorporated?
Hi, Jessica. Yes, I think structurally, if you look at South Africa, it's the banking sector per se, as Nick said, looks very attractive. Loan growth still trending up as into a declining interest rate environment, driven predominantly, we think, off the back of the Fed. We're going to follow the Fed down. Whether that's 50 or 100 basis points over the next 12 months, it's still coming down. So I think that, starting point from a conservative asset allocation perspective is these banks are very attractive. I think the big banks are not only growing in South Africa, they're growing outside of South Africa. First, had a couple of issues in the UK that seems resolved. Standard Bank's doing a very good job in Africa. That's our biggest single position in the funds currently now, Standard Bank. Absa will be coming back under new management. The market's competitive, there's no doubt, but at the same time, as we think there's a lot of scope. We're seeing a lot of corporate activity, funny enough, as Marco rightly said, the consumer side's quite lackluster still. We're not seeing much there. There's obviously been a lot of controversy in the South African market around gaming and people spending at the lower end, on obviously online. The retailers have had quite a big hit from that. So structurally within the space within South Africa, it's not all roses. The pick stocks in this environment that I think are number one defensive, that are going to grow, that are not going to see the impact of obviously huge competition or consumption, coming out of their sector. And again, I think you can play the insurers. Yeah, I mean, we've even started buying some of the hospital groups back now. They're looking really attractive. We've actually seen an uptick in certain of the patient days. So there's generally signs that activity in South Africa, although as I said, it's not shooting the lights out, is steadily climbing back up to levels where some forms of businesses in South Africa are going to get leverage. And obviously that's why you buy equities, is for the leverage on earnings. We obviously saw a very poor announcement from Fashini Group the other day, TFG, where they obviously top line is not that bad, running in the sort of 4-5% mark, but just not getting leverage against their cost base. So again, you've got to be positioned with businesses in an equity fund where you're going to be getting leverage, and where businesses are able to cut costs into an environment which is still going to be GDP, 1.5, potentially maybe 2. But we'll be jumping up and down at this morning meeting if we're in the 2% marks by this time next year or the year after. But again, like Nick rightly said and the other panelists said, I think there's still a lot of opportunity in this SA space. We deserve a big catch up. Our returns on some of these sectors are very good from a global perspective, and I think we're relatively well positioned to take up those advantages.
Right. Marco, just coming back to you, before we switch to locally, I think the last thing that I want to sort of touch on from a global perspective is obviously the gold price. And you've made a case for the fact that actually, as an equity investor, there's an opportunity cost between investing in something with where the price momentum has been extreme, but it's actually difficult to predict where it could go going forward, and allocating towards far more sort of attractive looking SA Inc. names in the portfolio. Will you please sort of elaborate on that and just explain some of the overweight positions in your portfolio at the moment?
Yeah, thanks, Jess. Obviously we all have a benchmark. We're all trying to beat, whether it's the Cap Swix or the All Share, hopefully beat peers and so on. But, we take a very important look at capital preservation as well. So, when you got a trade that is kind of running ahead of steam, think back of GFC type trades or, .com bubble. Potentially the thought of locking in certain positions at extreme levels that may be very hard to beat over a decade worries us immensely, particularly when you got the other side of the coin that is looking very cheap. So, You know, we're quite comfortable that as a valuation-based manager, you know, that you're likely to underperform when the market is becoming extremely frothy. And we're quite happy with that. You know, we understand that we're not always going to be at the forefront of those earnings. Just going back to gold, I mean, it's been amazing to watch how the sell side has reacted to valuation framework on gold. Bernstein did some really good work on that. They showed out of, I think, the 10 or 15 models that have been traditionally used to predict gold, you know, only 3 of them are giving you some form of upside. So, and if you look at the last 3 months in particular, the error term that you've experienced in that rally has been enormous. So basically, very few people have been able to predict that from a valuation perspective. So, you know, we would argue that, you know, one, it's very hard to predict that. We would acknowledge that there is a bull case, and there's certainly support from a macro perspective that would indicate that it may have legs. But, you know, we have to balance one, medium-term returns at a time where SA Inc. is looking very cheap, and on the other hand you know, you got a trade that is really run really hard that very few valuation models are predicting.
Great. Nick, in terms of constructing your portfolio, a big thesis is trying to understand the state of the South African consumer at this point. And you know, that extends from the banks to the retailers, both food and clothing. Can you sort of comment on, you know, when you've been speaking to management from companies, what do you think the state of the SA consumer is at the moment?
I think it's still very tough out there. No, you had the Fashini results that were mentioned. You know, there's discounting going on to get rid of excess stock. Maybe a bit idiosyncratic, but you know, consumers not in the best of shape. But things should start improving. So you're seeing a divergence between, you know, wages and inflation. So you know, guys are getting real kind of wage increases. We also have a consumer that's very sensitive to interest rates. You know, most of the debt in South Africa, you know, if you just think of your mortgage, it's on a floating rate. I think it's, you know, north of 90% is on floating rates. So lower rates should start, you know, feeding through into things. So management haven't really spoken about kind of big green shoots that they're seeing. The one that we saw, I think Evan mentioned it right at the start, is vehicle sales. You know, they're up over 20%, you know, year to date. There's a disclaimer on that. That's a volume number. People are down trading to Chinese vehicles. So the absolute number of spending isn't, you know, significant. But nonetheless, that is positive. But, you know, we need the Reserve Bank to continue cutting rates, and hopefully they follow the Fed. You know, real rates are still way too high. You know, I think they're close on 4%. They've got this 3% inflation, you know, target that they fixated on, and that's, you know, partially why they've been keeping rates higher. But yeah, if they continue cutting, which they should, then we should start seeing, you know, the consumer spending power, you know, increase.
Jessica, if
Yeah,
Eskom
brilliant.
if Eskom keeps giving 23% wage increases, I think the consumer will be fine, you know.
Yeah, wage increases, but at the same time, the rate at which they hike the price of electricity is also a factor.
Detriment.
So I suppose
Yeah,
the two
no,
offset
100%.
each other to a degree.
Yeah.
Yes. Liam, just for you, in carrying on sort of talking about the consumer, we've seen quite a few headlines, and maybe it would be good to understand whether this is significant or not. But there've been quite a few headlines about gambling spend from the SA consumer. So I mean, even the Pick n Pay CEO came out this week sort of lambasting the fact that there's no regulation in that sector, and that it's actually stealing from, you know, the consumer's ability to shop both for food and clothing. Is that something that you've sort of seen growing and becoming a material impact to managing the portfolio, or is this more sort of just a bit of a thematic issue that we've seen in headlines?
Well, I mean, I think it's quite nuanced. So my comments, and it's not just about gambling, is that firstly, we had a thesis sort of last year around the consumer in South Africa. There was a complete, you know, confidence boost in the economy after years of after years of just, constant negative headlines and not feeling good about being in South Africa. So sort of second half of last year, we did a lot of work across the market, particularly sort of general retail, discretionary retail, and a lot of the consumer-facing shares that we hadn't looked at for many years, in the mid-cap space. I can tell you early on this year, probably remember you also had the two-pot money coming in. There was a big thesis around a resurgence in earnings from these companies. And when we started speaking to them again, we said every second month we're going to really keep on top of if these corporates are starting to see change in trends, positive change in trends. We were quite constructive, and probably from about February onwards, there was you started speaking to the companies and they started saying, guys, like this is not coming through. We don't know why. Some of the companies were just completely bemused as to where the money's going. Then you started seeing the gambling stats and obviously and the gaming stats. And I mean, there's clearly been a lot of cash that has gone straight into that sector. I mean, the stats are there open for everyone to see. So certainly it has happened. But at the same time, across and this is little on sort of similar thread, like you do speak to a lot of the companies, and a lot of them are able to manage the environment that they're operating in. A lot of them make excuses. I mean, I think Evan alluded to TFG. I mean, we've had a very similar story from TFG for a number of years now, and with no delivery. And then there's been companies that have been able to weather the environment and thrive. I mean, you've actually seen some pretty big success stories come out of South Africa in the consumer space over the last 10 years, where they were able to just adapt to the conditions on the ground. And you didn't meet with them every 6 months and just listen to the excuse of the South African consumer is just under a hard ride. I do think that there's another issue in South Africa, is that I don't think our stats are necessarily reported correctly. So it's very difficult for us to get a real sense of how under pressure the consumer is. There's clearly a part of South Africa that is bifurcated. I think right at the top end, it seems like you resilient consumer at the top end. At the lower end, it's actually very difficult to tell because there's a huge informal market and it's very difficult to tell exactly what's going on there. Clearly in the middle, which is probably your more traditional, the data is probably capturing that in a more traditional manner that you would want to compare to other countries, like the interest rate sensitivities and nominal wage growth and employment gains, and that maybe that's the part of the market that's just throwing out a very negative message on the SA consumer. But I think we definitely are in a market now where there's been companies that have been able to. I mean, I just look at ShopRite as like an example, and it was just able to completely crowd out some of the competition in South Africa strategically. There, I look at Capitec was also able to do the same thing. So I think that there's been some companies that have been able to just adapt and thrive over the last 10 years, and there's a lot of companies that maybe just had a lot of excuses out there, and it's an interesting conversation to have, really. I think, because I think maybe also the stats are just very difficult to decipher in terms of what's really going on in the South African consumer.
I just want to add, I mean, it's a good point that Liam raises. So if you look at the gambling numbers that are floating around, you're hearing every corporate almost use it as a bit of an excuse for top line growth. But I think the incremental numbers, 15 billion rand year over year, that's gone into this online gambling. That's 1% of retail sales in the country, of total retail sales. So if 1% is going to derail your business, or the excuse is not really a great one, not dismissing it completely, it is a big issue, but there's just context to that number.
And I think it raises the point that actually the management team at these listed companies becomes incredibly important, in terms of that sort of problem solving for this changing dynamic. I just sort of want to move and talk about some of the workings in your equity funds over the last year. I've got 2 questions, and I want to move across each of you. How has the trading of your portfolios been over the last year? Have you seen an uptick in sort of portfolio turnover because of the change in environment, beginning to sort of more to the end of the year? And then the second question for each of you is, are there any derivative strategies employed in the portfolios at the moment, across a sector, across a specific stock, anything like that? So maybe, Evan, can we start with you?
Sure. Okay, there's quite a lot in that question, but let's try. We actively trade the funds, Jessica. So we really do look for opportunity all the time. We sold down our plats, we bought our plats back again. We've sold them down a little bit again on valuation. We've taken advantage, obviously, of rights issues of Valterra coming to market. We're very active in the space. I mean, that's our job, to be active. As boutique managers, all of us, I mean, we've got the opportunity set still to outperform the bigger guys just on activity, we think, to take advantage of extremes in markets, to try take advantage of moves. So, we actively do churn the funds. We don't apologize for that. So that's part of the job, is to find the opportunity set, which we think is attractive at points in time. So we, if you look back, and we happily said anyone, we send out, quarterly, we send out, how we've moved the SA equity portfolios between insurers, banks, retailers. Obviously we took up a lot last year, on very distorted valuations last year going into the GNU. We sold down a lot on what we thought were valuations were a little extreme for the SA environment towards the end of last year. We're looking again at them. We've bought back a lot of the banks, etc. So again, we actively trade around the macro. And we actively trade around the valuation if we think it's extreme, and we reposition back into sectors. So, that's part of the job, we think, and we think that's what adds attractiveness to the boutique managers in an environment against our big counterparts.
Okay, and any derivatives employed in the
Oh,
fund
sorry,
at the
the
moment?
derivatives. No, we don't put derivatives on. The SA equity funds are 95% invested equity fund, and it's not allowed derivatives. So we don't put derivative structures on that SA equity fund at all. And it really is a building block for, positions, across our other funds, our hedge funds, etc. will have derivative structures on, at all points in the cycle to try to protect capital. But obviously the SA equity fund, there you've got to have 95% invested at all times.
Right, Liam, talk to us about the trading within the portfolio over the last year, please.
Just on derivatives, same answer as Evan. We don't use them in the SA equity fund, but I use them extensively in the hedge funds. In terms of trading and turnover, I think middle of last year there was a lot of positioning that went that happened, and so last year the turnover was quite high. We shifted quite big into domestics and domestic mid caps. I would say, end of the first quarter of this year, we shifted into the basic material space. But I can tell you within the team that the conversation on pretty much every investment meeting kicks off with, guys, when can we sell these now? Because it's an uncomfortable position. I don't think that there's been an abnormal amount of activity levels. I think that there's just every couple of months there's a repositioning of the portfolio, and then I would say as probably quite similar to what Evan said, we're not afraid to turn the portfolio over. It's not our size as well on local equities within Anchor. We can easily move the money around, and we're not afraid to do that. Yeah.
Great, Nick.
Also very active. It's a bit of kind of as and when, because we typically take a 3-year kind of a view on any business that we invest in. So I would, in the ordinary course of business, we probably turn about a third, 25% of the fund, per annum. But then there's periods like, the past 6 months, we've probably added, 7% to the banks. 2 years ago, or a year and a half ago, we added, 10% to Prosus Naspers, in over a short period of time. So it's kind of like more as and when. It's a R1 billion fund, so it is quite easy to trade. And we are also, I would say, a bit more active in the mid cap, smaller cap kind of space. than what a larger fund would necessarily be.
Great, Marco.
Cool. Yeah, so we don't use derivatives either in this product. Look, and we follow a fairly disciplined process. We allocate capital on a medium-term view. But what has transpired over the past few years, the market has bounced around so extremely. If I look at our intrinsic value, how it's moved over the past 3 years, it's gone boom and bust, 3 or 4 times. So it's allowed us to be a lot more active. So, if we see value in a sector, we'll gradually move into it, in a very disciplined fashion. But yeah, we've been a lot more
Right.
active over the last 2 years.
Good to hear. This is a 45-minute panel discussion, so we don't have a ton of time left. So just in closing, to sort of understand a bit more about your portfolios. I mean, we've talked extensively about financials and some of the basic material holdings, but can you give us some of your favorite stock picks? They don't necessarily have to be in the top 10 of the portfolio, because obviously sometimes things are sized by liquidity and things like that. But 3 of your favorite sort of stock picks from your portfolio, just to give us a sense of what we can be excited about in terms of the active management plays that are employed over here. So again, starting with Evan.
Oh, wow, if you drop down the curve, I think there's a lot of opportunity in South Africa here. Some of them, for the private client side, I think, be relatively conservative. I mean, as we've mentioned, Standard Bank, we think that's our top pick in the financials. We would definitely own Naspers Process still into this AI tech revolution globally. We like the likes of, quite conservative. We like the likes of a company like Nepi. It's a property company. It's on a starting yield of 8% in euros. We don't think it's a bad stock to hold, just from a defensive positioning. It's going to give you a couple of % growth, but we think you'll get to double digit in euro terms. We own some small caps like Grindrod, which have done exceptionally well for us. We still think there's upside there in the SA side. So we think there's great and a very, very good business. It's probably my favorite from a PA perspective is Bidcorp. I think it's lagged the market quite extensively. It gives you global exposure to 32 countries. I think it's one that you can put in your PA and tuck away for a number of years. It's going to compound anything between 8 and 15%, depending on the landscape. Gives you global diversity, and it's a very, very good business. So again, we own that in the portfolios, and we'll trade that, Jessica. As I said, if it gets expensive, we'll sell some, and if it gets cheap, we'll buy some back. We've done the same, with Bidvest. It's setting itself up for another reasonable run. We think it gives you a good outcome across global landscapes. It looks a little bit over indebted at the moment, but they'll pay down that debt. So, we think there's a lot of opportunities. We think there's a lot within the SA landscape, and have a look at our top 10 positioning. I think you'll do well buying 3 to 5 of those over a 3-year view. And I do concur with Nick. We take a longer term view on most of our positioning. It'll just be valuation and extremes in that, which will mean they will reduce or we add based on flavor of the month.
Fantastic. Thank you, Evan. Liam.
Yeah, sure. So I would say in the larger company space, in the financials, we've recently been buying a bit of Old Mutual. We like the changes that have happened there at a management level, and I actually think in a similar vein to that, we own ABSA. We own quite a bit of ABSA and Old Mutual. Both of those businesses, structural underperformers for the last, I don't know how many years, over a decade now. Both got new management teams, new targets put out there. We think that there's not a lot that needs to happen for you to get a reasonably good outcome as an investor. It's actually quite different from our usual style at Anchor, where we usually try and keep a large quality underpin in the portfolios. But we think that there's quite a lot of optionality in both Mutual and ABSA right now. And then in the mid cap space, I would say our most recent addition is a little company called Kaap Agri, KAL, the ticker. It's a very micro, locally focused South African industrial retail business, and we quite like it. And over the next 2-3 years, we think that there's going to be some good earnings growth coming out of it, and we think the recent pullback in the stock has offered a compelling entry point.
Fantastic. Nick.
So, the larger caps, just banks in general, I've already said, I think, 7-8% dividend yield, nominal growth. So you'll get teen kind of returns. And, if we do get a re-rating in South Africa and things are a bit more positive, not far from a 20% kind of like return per annum that I think you can get out of the banks over the next 3 years. More kind of like mid-cap space, Advotech, we like a lot. It's just shy of a 5% position in the SA equity fund at the moment. It's not the most exciting story. I think everyone knows it, but it's a structural growing story of private education in South Africa. We think it can grow 15% per year for many years. And it's on 13 times earnings, return on capital, approaching 20%. I think it's exceptional value, something you can hold for many years. And then maybe a bit more kind of exciting, high beta, it's probably a company like Nampak. There's been a big turnaround there with Phil Roux. There's new management coming in. But Nampak still has many levers to grow. So they're in a structurally growing part of the market. Beverage cans are growing, even without SA GDP, growing 8% volumes per year. And we still think there's maybe a bit of margin for them to be had there. So that's around like a 3.5% position.
Fantastic. Marco?
Yeah, cool. So yeah, we like banks and insurers as well. Just maybe to give slightly different picks. Probably top pick, I'd say at the moment, Pepkor. We think it's a great business, very well run. The core retail aspect has been performing very well, and you got optionality via a fintech business. We think it's going to deliver double-digit returns over the medium term. Exceptional business. We like Advotech as well. We think you haven't had very many entry points for that stock over many years, and it's affording you a very good entry point. And maybe then on the industrial space, that has been a space that has been fairly difficult, but we like after the derating, the Wilson Bailey story. We think it's a good company. Hopefully it benefits from some of the growth prospects that we're seeing at the moment. And maybe a final one, Bidvest. I think that it's been so bombed over the last couple of years. We think it's a very good business, and there's a lot of base effects that should normalize over time, and we think it's valued for crisis type mode. So yeah, I'd say probably those four are our top picks.
Fantastic. I think it takes a lot of guts to sort of share your expectations and your stock picks, as an active manager, and then sort of be measured against that in future. So I just really want to thank you all today. I think it's very clear that there's an incredible amount of critical analysis that goes into building portfolios on behalf of clients, and it's not just to participate in this great performance, but actually to also protect clients, when things turn against expectations. And so really it's been an absolute privilege to listen to all of you today and sort of hear your views. And with that, thank you so much to Pierre and the team from BCR Fundrock. Just to hand back to you, thank you so much for the opportunity.
Thank you, Jessica, and thank you to the managers for joining us. I think from maybe just briefly from our side, Apex Investment Consulting, we've been fairly positive about the opportunities in emerging markets generally, including China and South Africa. So we look forward to a cycle from a macro perspective, maybe where there's a bit more tailwinds to emerging markets, including South Africa, and especially if China can keep or get going really in a proper way, they will pull South Africa along. And I think in that context, we are very lucky in South Africa that we have these good boutique equity managers that, as the market hopefully kind of broadened out, apart from the golds and the metals driving our markets, that they can really generate sustainably nice returns for our investors from the broader SA market. So yeah, thanks to the managers for the work that you've been doing, and we look forward to that. Thanks to the audience for joining us today again, and please join us next week, the 5th of November, for another Boutiques on Wednesdays. We'll have Cartesian Capital and Saffron Wealth. So I'm sure we'll get some fixed income views as well to balance the equity views we got today. So please join us again next week as we head towards the end. Thanks, Jessica. Thanks, managers. We appreciate it. And thanks to the audience.